in our investment process, there are three critical factors that we look at: buying, sizing. Sizing is very, very key to us. How much do you buy before you buy? What is the level of percentage in the portfolio before we make a bet on a company? I'll later on demonstrate how we have built this portfolio by focusing a lot on sizing. Selling is nothing but staying disciplined over a cycle. So our endeavor on the buying side is, if we buy great businesses, we want to buy them at fair value by not overpaying for greatness. And I'll just sort of elaborate on how we think about great businesses. It is our belief at InCred that any great business can go through 3, 5, 10 years of zero return. Whether it is a Coca-Cola, it is a Microsoft, it is a HDFC Life, it is a HDFC Bank, it is a Kotak Bank. Most of the businesses that I know of, 99 percentile of the businesses on the stock market goes through 3, 5, 10 years of zero return. Now, what makes these businesses great is that when they bounce back, they more than make up for the gain of those 3, 5, 10 years. And this is how we are trained to think. There are two ways to make money in a stock: compounding of earnings, expansion of multiple. Our focus is that whether we can minimize the risk of multiple contraction in the businesses that we are buying. And these are the kind of opportunities that we wait. The next 5 years or 10 years subsequently are very, very different in most of these businesses. So what we try to do is we try to capture these businesses after they have not made money for 3, 5 years, simply because we don't want to overpay for greatness of these companies. If we buy good, we always buy it at a discount to intrinsic value. It could be 1/3 discount to intrinsic value. And a lot of endeavor in our process goes in terms of eliminating bad attributes in a business. And one of the things that I have learned in my investment management career is that if you can improve your strike rate or your hit rate from 55 to 60 and 65, you can be a very, very successful investor. Now, there is one element of not making the same mistakes that I would have made in the past as a manager. But the second element, not to be in areas you don't understand and move away from your circle of competence. So a lot of emphasis on sort of companies wherein we have made an error in judging a promoter. Essentially, it is a conscious effort. It happens over a period of time. On the sizing bit, there are 3 levels of sizing in the portfolio. There is a 7 to 10% weight in a portfolio. There is a 3.5 to 5% weight. There is 1.5 to 2% weight. But what we do very successfully, I think so, is when the stock is declining from the, let's say we have bought Neural Labs at 1,200 rupees and the stock went to 950. We would always buy more of it if the thesis is not sort of broken. If the thesis is broken, obviously we'll run to the door and book a loss. All of that is fine. But what we do very successfully is that as the price becomes in your favor, we tend to think more return and less about risk, basically at juncture. Selling is absolutely very critical. I think so. This is nothing but staying disciplined over a period of time. And we have demonstrated it to people that, possibly the art of fund management comprises 50% of this process focused on sizing and selling, as opposed to, only thinking about buying critically. Now, there are times wherein, the risk to reward is more tilted towards risk and less about reward. That is a time wherein we sell call on a particular stock, or, we don't blink an eye in terms of, guiding our investors in the right fashion, that this is the time not to allocate to equities. Now, the question comes that, how do we limit error in the process? And this is a framework that we have. The framework is divided into quantitative and qualitative parameters. In sum and substance, what we are trying to do here is that we'll buy great businesses by not overpaying for greatness. We are happy to buy good at a discount, but more importantly, eliminate the bad attributes in a business. And this framework captures ROIC versus WACC, capital structure, cash flow adequacy, covenants, and growth. A lot of our companies go through a headwind in a business year or in a business cycle, but they would be gaining market share in a headwind year. And this is how we benchmark greatness. We, obviously have a fair bit of tab on whether the company has a competitive advantage, whether it is a wide moat or a narrow moat company. Pricing, how is the character of management is absolutely very, very important to us, because it helps us to, when the business environment is not in favor, characters helps us to hold that company in a down cycle. And hopefully, in the next cycle, we will see, so how do we judge character? We look at things like related party transactions, management remuneration as a percentage of PBT, contingent liability as a percentage of net worth. We would also look at, alignment of interest in minority shareholders, how aligned they are to well-being of minority investors, because I'll be always a minority investor, and dependence on external variables. This is how is the regulation in the sector. Now, with all of this, what do we look for in a company? It is a combination of superior capital allocation skills, superior management, potential for obviously high growth. We specialize in identifying small mid-cap companies, and this is the way we think about, investing, wherein small can become mid can become large, and if you invest into a large cap company, whether it can become giant. We call this as market cap graduation over a period of time. And this obviously leads to from value to discovery stage. The discovery leads to P multiple expansion of a lot of these companies. And then there is an inflection point in terms of their cash flow generation, right? From operating cash flow to generating free cash flow. And all this with a very, very reasonable valuation framework. So if you look at our portfolio statistics, what you'll find is that at all times, our endeavor is that if the market earnings growth rate is 15%, let's say, on an average in mid and small cap, our endeavor is to buy companies which are at least 50% higher growth rate than that 15% number. High return on invested capital, which reflects the quality of companies with hopefully with no leverage. At a portfolio leverage level, leverage is very, very controlled. Lot of our companies, out of 22 companies that we have in the multi-cap, 12 companies are debt-free, debt to equity ratio of 0.15. They don't have we don't want any business to have a mortality rate. And how do we ensure that? Typically, when we look at small or mid-cap companies, typically our threshold vintage of a company is 25 years. And this is what our belief is. First 10 years in India, if you start a brick and mortar business, go for up to scale in terms of break-even, solving for your unit economics in a business, and solving for financing. Next 15 years go in terms of establishing credibility with your customers and validating and increasing your market share and solving problems for your customers. Once you are past that 25 years, there could be companies wherein, they come to inflection points. So if you look at, our top holding is a Indraprastha Medical, a Tejas Network, or a Newland Labs, average went going to be, 25 to 40 years.